joining us here today, I'd like to welcome Singying Chem, Director of the Singapore Battery Consortium, Christopher Gale, Managing Director at Latin Resources, Alan Ray Restoro, Associate for Metals and Mining at Bloomberg NEF, Sean Sampson, President and CEO at EV Nickel, and Joyce Jing, Head of Business Development at Theme International Trading. And so to kick things off, I think it would be great if we could get just a small introduction from each of our panelists so that you know what they're all about and why they're here today. So Joyce, if you want to kick things off.
So thank you so much, Amy, for organizing one-to-one again here in Singapore. It's really great to see every market participants and see you again. So my name is Joyce, and I now work at Theme International Trading. We are a Singapore registered and licensed fund / market maker specializing in commodity derivatives trading. And our aim is really to bring up liquidities into the commodities paper market and to help with market participants in terms of the physical price risk management or in the financial markets.
Got mine. Hi, Chris Gale from Latin Resources. Latin Resources is currently developing a lithium mine in Brazil. And we've been operating in South America for 15 years, Peru, Argentina, and Brazil. And we are very focused on getting that developed into production over the next few years.
Pleasant day, everyone. And I'm Alan from Bloomberg NEF. I'm one of the associates under the Metals and Mining team of the Commodities group. For those who are not as familiar, Bloomberg NEF is one of the primary research services offered by Bloomberg. So we are part of the Bloomberg umbrella, and we focus primarily on providing strategic insight and research towards a cleaner future. I personally am part of the coverage on battery metals and some of our short-term work on industrial metals as well. And it's great to be back in person here.
Hi, good morning, everyone. My name is Sing Yang. I'm from the Singapore Battery Consortium. The Singapore Battery Consortium currently is a group of about 40 companies. And we look at the innovation space across the TRL in R&Ds. But mostly we want to target some in the areas of pre-competitive research, where we work with the public stakeholders to fund some of this research. So in the last 2 years, we've got about $25 million worth of projects going. And we'll see more of that coming in the next 2 years as well. Nice to be here.
Hi, everyone. My name is Sean Sampson. I run a company called EV Nickel. So we are a mining company. I'm based out of Toronto, Ontario. My assets are in Northern Ontario, so just an hour's flight north from Toronto. And I have a high-grade nickel resource and a very large low-grade mineralization. So we are developers with the intention of being up and producing nickel with an existing plant that's nearby in 3 to 4 years. So that's what I'm here for, to talk about nickel.
All right, great. So thanks everyone for joining us today. To kick things off, the big story right now in the battery metals is about the perceived shortage in the key metals that are going to be driving the energy transition. So as supply deficits across the battery metal space continue to grow, where do you see some of the biggest gaps in supply coming on? And I guess as a follow-up, what are some of the critical areas where you see demand growing, either as a result of changing battery chemistries or ESG concerns, supply demand?
Yeah, just focusing on raw materials, and I suppose Sean can also answer through this, but just as a potential provider of those raw materials, certainly over the last 6 months, while developing our project, being the Phoenix Raw Markets Conference in June, Perth held the Asia Pac Gigafactories conference last week. The bottom line is that the reason why we're seeing such a high demand for raw materials is obviously the growth. So the world's going to grow from 3 to 4% EVs currently to around 50 to 60% over the next 10 years. You don't have to be a rocket scientist to sort of work out that you're going to need a lot of materials. From the financial aspects, Joyce, I saw a slide benchmark put up last week that $40 trillion needs to be invested into electrification sector by 2050, 40 trillion, 10 trillion of that into battery metals. So that includes renewables, wind, solar, transmission lines, infrastructure for high charge stations, etc. There needs to be 40 lithium mines built over the next 10 years to meet the world's demand for lithium. Sean will speak on nickel, but it's pretty high as well, and copper. That 40 lithium mines over the next 10 years need to be built to meet demand. I'm from Western Australia, which is one of the greatest mining jurisdictions in the world. Our lithium guys, Western Australia went providing 11% of the world's lithium back there in 5-6 years ago to now 45%. We have, and the guys built 4 lithium mines in 5 years. We need 40 in 10. There's a supply crunch on its way. It's here now. Obviously, the lithium prices are through the roof, which in itself is a bit of a concern. So that's where the world's sitting on lithium. I'm sure I might want to talk about nickel. And, you know, it's just all about getting that raw material out of the ground as quick as you can.
Yeah, so it's a continual same story for nickel. I think the disconnect really comes, and I've been traveling for the past few weeks, including I was in Spain 2 weeks ago with a raw materials conference where most of the big car companies were there. And it's really interesting to look at the speed with which Tesla, for example, built their gigafactory outside Berlin, which was from concept to operation, they say inside 36 months. But the mining business, of course, it takes you so many targets to find mineralization, and then it takes 10 to 15 years to get mineralization turned into a mine. So there's a real disconnect between the raw materials side and the car companies and their expectations. And frankly, when you speak to the buyers of the raw materials at the car companies or the battery companies, coming at it from an automotive perspective, they say we just need to think differently about it. But it doesn't add up. So there is clearly a disconnect between the forecast growth and demand and what the subsequent supply is, and also the potential to change the game in that supply, because you just don't find mineralization or turn on a mine like you do a gigafactory. And when you stack up the plans for gigafactories and the required inputs, the raw materials, there's a huge mismatch. So from a nickel perspective, it's a little different in that it already is a global base metal supplying the stainless business. And now we're ratcheting on top a new demand category with electric vehicles, which is just increasing the demand requirement, which aggravates that demand supply gap. So they say by 2030 that the majority of nickel will be going into battery EVs. But that's really only if it's discovered and brought online, because if not, there's going to have to be some pretty serious changes either in the growth forecasts for battery EVs or within the battery chemistry. So as someone that is sitting on a lot of nickel and trying to get it up and into production, it's a good position to be in. But obviously, the decisions that are being made around construction of gigafactories and for what chemistry they're planning on supplying, they're making decisions that requires them to find supply very quickly. And there's a real crunch. So I've seen it as well over the past 6 months that the attitude
It was crazy on 25th
completely
of
changed.
March. It was crazy. Yeah, the whole nickel paper market just went up there and without any control. And what should the physical market participants do if they are buyer, if they are hedging for their future long-term procurement? And the prices went up so high like that. And that's the importance of hedging, I guess. Thanks for the point, Sean. Appreciate it.
Well, maybe I'll add a little bit about how the chemistries, how the supply affects actually choice of chemistry in research as well. I was talking to Sean a little bit about that. So all the hype in the past 2 years was more to look for cobalt-free battery research. But now I think with the nickel prices, I think some of the companies, especially within consortium as well, has looked at, well, how can we pivot? So the high nickel content in the NMC 811 was one of really the key battery chemistries for very advanced automotive side. But to pivot, you need to then also to maintain your 532 chemistry, for example. There's lower nickel content. So those have to come in when you look at building the battery plant as well. And then manganese as well. Manganese is currently not a big factor in terms of the cost, but they might be pivoting to high manganese content cathodes as well. But then not to forget, of course, the LFP chemistries, which the Chinese have been very successful in commercializing. So those then are free from the nickel, cobalt chemistries, but not the lithium side of the supply. Yeah.
Yeah, thanks for all the insightful sharing. And I completely agree. It's been a crazy past few months and honestly, past 2 years. I guess I can share more on from an EV approach down to how it impacted our research on battery metals demand and supply. Overall, in our latest electric vehicle outlook, which is one of the flagship publications that we do, we forecasted that if we compare our outlook from 2021 to what we have now, annual battery demand by 2030 in terms of terawatt hours will reach 4 terawatt hours globally. And if you compare that again from last year, that's a 23% increase. So obviously, it's been growing since we started the annual forecast, and it continues to grow. A 23% growth is massive in this scale if you compare it to other growth rates. And what that essentially translates into is definitely growth in battery metals demand. So we do forecast a certain assumption of a lag time around 1 year, meaning that the forecast for 2031 battery demand actually goes into 2030 metal supply, since that metal supply needs to go into the manufacturing value chain in order to go into actual EVs. Now, what we've seen is that definitely there are supply gaps across the board. That's, I think, a well-known fact now. But in terms of actual metals that we're looking at, copper and aluminum continue to take the largest share in terms of overall volume and size of the amount of materials needed. But in terms of the fastest growth drivers, we still see lithium and nickel bearing the brunt, growing around 123% and 117% respectively by just 2025 alone. And knowing the factors behind demand, it's really interesting to see how the conversation evolves around chemistry, right? So previously, our forecasts for lithium iron phosphate or LFP chemistries was just around 20% at most. But in our latest forecasts, we've been ramping it up around 25% by 2030. But if you include other LFP-based chemistries across the board, it's now around 32%. But that being said, of course, LFP uptake, which was unexpected if you ask people from the industry maybe a couple of months back, what we're looking at now is that nickel-based chemistries or nickel-rich cathodes will continue to take up a larger share and the largest share in the market by the end of the decade, which is just about higher than 45%. So that includes your NMCs, NCAs, and all the other chemistries based on nickel-rich cathodes, which we actually sort of termed as performance chemistries, since we have a tiered system in identifying chemistries in order to have a view on how it impacts different markets. The growth in LFP is more towards the low-cost segment, primarily in China, where a lot of the actual sales are towards those that only need a car through city driving, doesn't need that much range, and therefore LFP-based chemistries are already providing that performance need. And if you compare battery chemistries from a while back, the LFP of 2011, 2012 is not the same as the LFP we have now. Battery chemistries alone have really evolved into being better performers, right? So those types of changes really impact the actual demand that we see. Even if we forecast higher demand for batteries, the chemistries alone would require not not really a smaller amount of metal per vehicle, but overall a more optimized approach in terms of demand forecasting. Now, in terms of supply, what I can share is that there's really a limited amount of mines currently set up. I think this was really captured in the previous segment during the presentation, where there really is a need for more commitments to projects in lithium and nickel specifically. But what we found out, which I'll point to the sharing earlier about cobalt-free batteries, is that remember our point towards greater battery demand in terms of actual energy, in terms of 4 terawatt hours by 2030. If we compare our cobalt forecast in terms of demand in the same outlook, our forecast in 2019 is actually 50% higher than the cobalt forecast we have for 2022 outlook. And that means that the decline in demand forecast of 50% comes at the time when we actually forecast more batteries. And the main point I would like to share in this panel is that, of course, there are supply risks abound, but we're seeing that the industry is responding. That massive shift in terms of cobalt demand declines is really pointing towards cobalt remaining a key risk to supply chains, especially from manufacturers who are looking at ticking boxes in their ESG initiatives. And again, cobalt-free batteries are essentially one of the key drivers of that decline. And with that decline in demand, even though we revised our cobalt supply forecast down because of the geopolitical tensions within the mining players in the DRC, it still resulted in a quite balanced market for cobalt, at least in the short to mid term. So even if supply risks are there, the demand from the response from the industry on the demand side actually adjusts towards managing some of the supply risks, and we're likely going to see that further if supply risks exacerbate, especially on lithium and nickel.
Just as a reminder to the audience, we are taking questions throughout the course of the panel, so definitely just feel free to raise your hand and we'll bring over a mic if you have any questions for our panelists as we go. So as Chris mentioned, there's been reports about a significant amount of capital that's needed for the mining industry in order to meet these global decarbonization goals. So where do you see the financing coming from? And what sort of projects, regions, commodities, where is it going?
I'm on the derivative side, but yes, definitely, because derivatives, essentially, they are a tool to help the market participants in terms of the followings. First is to hedge, to lock in your futures procurement price or your future sales price for your inventories if you are a consumer or producer. And secondly is to help you secure your capital funding from the banks, because when the banks, so it's like turning into a futures unknown price into a fixed number, so that the banks, they are more sure, or they are more certain about where they are going next. So that's how I believe junior miners can benefit from the trading the derivatives. In terms of trading here, for the industrial people, we call it hedging. Yeah, I'll pass the question back to Chris to add on more points.
Well, yeah. Look, there's no shortage of money out there for companies that are moving into development. The interesting aspect and their point about cobalt being phased out, I think cobalt's been phased out based around geopolitical issues, not only price, where that cobalt's coming from. And I've seen numbers that show that they're phasing cobalt out, the lithium-ion batteries, which are the batteries, arguably the batteries of the future. Lithium is more lithium required. So you're phasing out one material but they need to replace it with another. So, it's quite interesting you're not going to be able to phase out all the materials because of price. It's just not going to happen. There's a lot of money out there at the moment for companies like ours, like Sean. The other interesting aspect that I've been thinking through is that we need all this lithium. I can guarantee you every lithium mine, and I can't speak for nickel or copper, but every lithium mine that's out there has a signed offtake with either a car manufacturer or a processing plant. So there's no more lithium to give for this supply either. It's intriguing. So we've made a decision at Latin Resources not to look at signing any offtakes until we've got at least our resource, but more likely our scoping study completed. We think that the ball is absolutely in our court now. We're in a very good position to move forward. The funding is going to be very important that we have the right partner for funding. I'll set you an example of where I think, from the car manufacturer's point of view, Ford just recently invested $300 million into a company called Liontown Resources in Western Australia to secure raw materials. We're starting to see car manufacturers go direct to raw material suppliers to secure that raw material. The only time that ever happened before in the industry was when Henry Ford made the T-model Ford. He didn't have any rubber for tyres, so he started buying rubber plantations. He actually built a big rubber plantation in Brazil to get hold to some ensure rubber supplies. It's quite fascinating seeing what's happening now with car manufacturers. Rio Tinto signed an MOU with Ford 4 or 6 weeks ago to provide aluminium, nickel, and lithium. Rio Tinto don't have any lithium. Their Jadar project is proving very difficult in Serbia. They have a Rincon project in Argentina, of brines, which is going to take 3 or 4 years to get in development. So even the major miners throughout the world are struggling to secure raw materials for companies like Ford.
It's great to have the historical context, Chris, that you were around back in the Henry Ford days. To your question, though, about where the financing is going to come for this huge challenge, I don't think any of us know. So, as you say, Chris, the car companies and the battery companies are going up the chain to make investments, and it's interesting to see them now. We were talking about this before, Chris, looking at pre-resource companies, which is wild to think about. But the bigger picture is this long tail of how long it takes to find resources. And the reason we don't have enough projects now that are, as you say, development stage when you can find financing is because there was not exploration over the past decade. Mm-hmm. And that all reflects what the prices had been at that point. So the real disconnect for us is the early stage mining business, which is a very basic business, which is people out exploring and looking for deposits. And historically, that has been financed from global equity markets, where you've been able to attract investors who are looking for a high risk, high return type investment. But there's been a dearth of that investment capital. There's been a shortage of it because there's so much other high risk, high return asset classes to go after. So historically, these exploration companies, which I've been involved in, they can't access funds as easily as they were able to. They were soft metal prices. And now, 2022, everybody wants to have new raw material sources. And it doesn't work that way. We need to now be exploring to try to find the assets to move them along to the development stage, at which point you can find financing. So as an industry, and I say that, in the global sense, there needs to be a better way of financing that early stage stuff. And even now, the new demand, the car companies, the battery companies, they're looking at development stage and pre-development stage, resources. But who's going to go out and be exploring to find the next deposits? I think that's still a broken financing model.
Yeah, I totally agree. And although I don't work for the banks, but from past experience, I still remember the conversation last time. Pre-COVID, that was the last business trip to Perth. And I was speaking to a couple of bankers, and everybody was complaining that there is no way that they can get the structured deals because they were worried that lithium prices were tanking actually in 2018. And all of the bankers, my apologies. I hope it's not recorded. All of the bankers, they were actually, they were finding it such troublesome. Everybody wants to be into the market, but it's so difficult for them to get the approvals, the regulatory approvals, the internal management approvals, etc., to support funding of the junior miners. And I had friends in Perth, our lithium junior miners. They were looking out for OTC lithium swaps to lock in the prices in the next 5 years. However, at that time, there was no such contract possible. There was no one in the market doing this. And things have changed. Things definitely have changed. We have seen so many new battery metals, derivatives contracts, futures, aka swaps, and coming up, and they are exchange listed. So from my personal experience, I've been dealing with the battery metals derivatives, the futures contract since the day of launch. So I still remember on 14th of December, 2020, CME, the Chicago Mercantile Exchange Group, they first launched the cobalt metal contract, and it has since been trading and growing, and the open interest, I might be wrong because I didn't check the latest data this morning. It has definitely surpassed 5,000 lots, which is 5,000 tons on the open interest side. And it's been trading all the way along the forward curve until 2024, which means there is definitely demand to hedge, to lock in the price, the futures price of the cobalt metal until 2024, until a longer term. And the contract, well, I remembered we were discussing the contracts with exchanges, with brokers, with service providers like analysts, like Bloomberg, Platts, Fast Markets, everybody in the market, that the first contract, it was only designed for 24 months forward. But now it can be traded until end of 2025. And we have seen so many progressions on the price risk management tools side to really help physical market participants in terms of a brighter future of the battery metals. And on lithium side, interestingly, lithium market, well, from the conversations, chats with friends in the industry, people don't really see lithium as a commodity, and people highly doubted lithium can be traded back in 2019 and early 2020. However, lithium contract has been launched on CME, and cobalt and lithium contracts have launched on another exchange, SGX, Singapore Exchange, very recently, actually, this month, on 26th of, last month, sorry guys, 26th of September. I remembered on the first day, we traded lithium carbonate and lithium hydroxide, November and December contract at a fair price at the market, around market level. That's about 70-ish US dollars per kg, which we definitely see great potentials in battery metals derivatives side. And I really, really hope that the growth or the development of the financial market will help push the financing and make everybody's life easier.
We have a question from the audience.
Hi, I have a couple of questions. The first one is the financing model. I was just trying to understand among the majors whether there's been a change in behavior on funding of exploration and also tying up joint ventures with exploration companies. I mean, we see that in the gold model, right? The royalty modeling, the prospecting model, and so on. But I haven't observed that very much in some of these industrial metals and battery metals. I was just wondering what the sense by the majors are and how they're going to progress? Have they changed their attitudes towards, going more active in the exploration space?
That's an excellent question, and you're right. BHP explores here, probably for a reason. I can't see any other way the big miners are going to get battery metals without JVing with the juniors. And that's traditionally the model. It's us guys on the Australian Stock Exchange. There's 2,100 listed ASX companies, 900 are junior explorers. 5% of those will end up mines. So traditionally, the big boys let us go out, the Canadians, the Australians, explore the world, have a discovery, develop that, and then they will come knock on our door and either JV or take us over. That's part of our model. We haven't seen it yet. It's quite interesting. Rio Tinto promised Ford all this lithium within the next 3 or 4 years. I can't see any other way than them going around acquiring or it's going to be, I think the next phase of the battery metals is consolidation M&A over the next 2 years. Because we're going to need money to develop our mine. I'm sure Sean is. So watch this space. It's a great question, but they'll have to move pretty quickly.
Maybe they could set up a fund or something like all the tech companies do. Sorry? Set up a fund or something where what the tech companies do with startups, right? But
And
I
I
don't
think
see
that's
them doing that.
that's the model that BHP is. Look, that's somebody here today from BHP Explore. So, but Chris, I agree. It's very interesting to see the change that they're signing offtakes now before they have the metal. I think that's new. So maybe, but they're very serious. I've met with 3 of the majors about our project, but it's still, that's the circle of life for a junior miner to get picked up by the next size. But that needs to accelerate very quickly if that's going to be part of the answer for being able to speed up the supply with mines being built. But I have not seen a change in their behavior to match what is this forecast shortfall.
The other thing is also on the regulations that have come out with governments looking at protectionist practices, for want of a better word, with critical metals. Right, look at the U.S. regulation on subsidization of critical metals. Right, so do you think that from the way it's projected, do you see that that could be a challenge as well to meet those obligations, to meet the standards of having locally sourced or sanctioned materials from sanctioned countries? Do you see that as a
From my
challenge?
perspective, I think it aggravates this crunch where you have the protectionist guardrails being put up. So whether it's the Inflation Reduction Act in the U.S. Or it's the very serious ESG rules that are about to go into effect in Europe, it just creates a much smaller world of options for supply that this downstream demand can source from.
So do you all get any funding support from governments? I mean, seeing that they require some of these metals to be locally sourced, right? Do you see a lot more support from governments?
Well, there's certainly government interest, and yes, I have direct support, especially around my research and development for my business. And there are, on a weekly basis, triumphant announcements made by Western governments, whether it's Canadian, US, European, about critical metals strategy. So there's a lot of announcements, and subsequently they're trying to figure out ways to have that fit in to developers. But I've seen it personally on our research and development. And likely that's a new investment model as well, where governments themselves are looking at making investments upstream to try to dislodge this logjam.
With the Australian government, that has started a couple of years ago. The Australian government have had a critical minerals list for some time. They wouldn't, they haven't thus far prevented those critical minerals being sold offshore. But what they are doing, they recently put $120 million into a graphite project in Australia. So there is a massive fund in Australia to help those critical minerals. I think what the US Biden's recent critical minerals list means that they will only deal with certain countries to develop or use those minerals. USA is going to build 13 gigafactories over the next 10 years. They're going to need raw materials for each one of those gigafactories if they want to go into the processing side. So gigafactories builds batteries. China still has 90% of the processing power for lithium hydroxide, and you know, they buy Australian spodumene, turn that into hydroxide or carbonate, and then move that on. Argentina and Chile obviously use carbonate, develop carbonate from their salars. So we're going to see a massive shift in processing power into the US. But they're going to need raw materials. So where are those raw materials coming from? That's the question you've got to ask.
And it's an interesting trend. I heard a talk from a representative of the EU 2 weeks ago, and she was saying from an historical context about how the immense shift in wealth from Europe to the Middle East over the past 125 years of the internal combustion engine, and yet the European regulators or European governments never contributed to societal change in the Middle East. And at the EU, they speak openly about now they're making decisions around where raw materials are going to come from for this next phase of mobilizing. And they're certainly not going to make just blind upstream choices. And really, this was a conversation around ESG guardrails and Indonesian supply. So they're not just going to blindly accept supply and not influence or nudge upstream practices. So something's got to give there because they put up these very clear guardrails, but the numbers don't add up. Just as you know, Chris, with lithium in Brazil, you know, where does the lithium come from for the U.S. gigafactories from their list of acceptable countries? It just doesn't add up, right? So something's got to give on these fronts for raw materials.
Any other questions before we continue?
Hello, hi, morning. Quick question here, since Chris mentioned, BHP having a little bit of problem in China with the lithium sources, and we are on the topic of lithium. So can I get a panel's expert opinion on what do you think about the lepidolite sources that are said to be coming out from China? How big is this source? How soon can they come to the market, and at what price? Thank you.
Are you from Goldman Sachs?
Obviously, I'm not.
At these prices, and Joyce just mentioned an auction or the hedging, Pilbara Minerals have got a BMX program that auctions off their lithium. That hit $7,000 last month, highest ever for spodumene. The lepidolite, as we know, is a low-grade lithium. At these prices, it can be very viable. One thing that I think my Western Australian compatriots did wrong was brought too much lithium too quick back there 2 or 3 years ago, and it overfed the market, oversupplied the market. So lepidolite, and that's what the Goldman Sachs report from memory was based around, all this lepidolite's going to come on in China. It's hard to process. It's not the ideal field. Lithium hydroxide is very, very technical. You need the right feedstock for that lithium hydroxide. If you have 2% out in that chemistry, you have to start that batch again. So firstly, lepidolite is not a great feedstock for someone like lithium hydroxide. Lithium hydroxide is going to be the preferred chemistry for batteries of the future. We're pretty sure of that now, unless some technology comes out over the next 10 years and destroys the whole thing. But lepidolite at these prices can make money, and as we all know, the Chinese are very good at processing and getting things done. I think that will come on. But if that price drops back, that lepidolite is not actually viable anymore. It'll fall off the face of the earth. So it's very important when you're phasing things out like cobalt, a proven, lithium ion cobalt batteries are proven technology. They've just phased cobalt out because of obviously those reasons we discussed earlier. But what we're seeing is pretty technical type specs for lithium hydroxide coming through, and that material feeding that lithium hydroxide chemistry has to be pretty well spot on. If it's not, you're going to have failures.
All right, thank you for that. The price at which this lepidolite will disappear from the market, could you put a range on it?
A range.
A range on that price, market
a
price
rate?
at which this lepidolite is no longer viable?
4 years ago, they were getting $450, $500 a tonne for spodumene. I can't talk in carbonate. I think carbonate dropped to about $4,000 or $5,000, Joyce, didn't it? Lithium hydroxide, $70,000 a tonne at the moment. I'm not sure on carbonate. I know that prices of spodumene about $5,000. Our neighbour, Sigma Lithium, who's a $4 billion listed lithium company, has had a great project in Brazil. Their costs are about $450 a tonne, and they're called a low-cost operator. You wouldn't want to see it below $1,000 a tonne. I know Pilbara were making money at $700 a tonne. So around that $1,000 to $1,500 is where you want to be. Lepidolite's got no chance if it drops to $1,500 or $1,000 a tonne. No chance.
Right, and the first part of my question earlier was, what do you think might be the supply and in annual terms from lepidolite? 1,000 tons LCE, how many thousand tons do you think could come out of China?
I haven't looked at those numbers. I think you need to read Goldman Sachs report for that. And from my understanding that there was 2 analysts out of Shanghai wrote that report on the lepidolite, so perhaps give them a call. But we know that, for example, there's going to be, 3 years ago, there's 1 million tonnes deficit by 2025 of lithium. The number is now 2 million tonnes and 3 million tonnes at 2030, deficit of lithium with current production. So there's got to be a massive deficit. So you're not going to get 40 mines up and running within the next 10 years. It's just not going to happen. As Sean mentioned earlier, it's for a lithium carbonate mine in Argentina or Chile to develop, it's 5 to 10 years to get that into production. Orocobre, which is now Allchem, took 9 years to get to nameplate production. And they're a great company, and they're they're still building that nameplate production. For a spodumene hard rock mine, it's 3 to 5 years to get that into production. So I said earlier, there's 4 mines were built in 5 years, and they did a fantastic job getting that into production so quickly.
And that's after you know the deposit, you've discovered the mineralization.
Exactly. You've got your JORC, you've done.
Yeah.
As Sean mentioned earlier, and I spoke to Sean earlier, we haven't announced our JORC resource yet. I've got 16 people on my offtake list. It's fear of missing out is well and truly out there.
Which is not normal, right? Like what we're in right now is not normal. Yeah. It's crazy.
Not normal. But, we've got a neighbour called Sigma who have a massive deposit, the same geology. People can read. They want to get to you before you actually get your resource. As Sean said, that's unheard of. It's unheard of. Normally you need a DFS before they start talking to you. So that clock has moved from DFS to PFS to JORC to maybe we'll have a resource. It's mind-boggling.
What's also interesting there is a sort of rethinking of this. I mean, we're operating in the JORC model of resources, but in terms of lepidolite, for example, and other unconventional sources of lithium, we don't really see mineral reporting codes being heavily at least considered in developing some of these resources. This can also be seen in Indonesia, for example, where the average for nickel projects in terms of development around 10 years. Some analysts, especially the ones focused on Indonesia or have been involved in Indonesia mining projects, where I mean, I'll be blunt, it's a bit difficult in terms of transparency around those projects. You don't really know around what their resources and reserves are. But we see the actual output and development of these projects. And there's this sort of rethinking around um, not really moving away. I believe that transparency and mural reporting codes are essential to avoid another BX scandal. But overall, in these projects, given that we are in a tight supply market, some of these are being circumvented to actually directly provide output. And but yeah, I mean, unconventional lithium sources, unfortunately, they're not likely to be the solution. But they're we my thinking around it is we should avoid a tunnel vision around unconventional lithium resources, because while they do help with the current situation, it's unlikely that they will be a long-term solution. There are a lot of other options around the market that the industry can take, supporting more transparency in pricing through hedging at commodity exchanges, for example, which unfortunately for lithium, I think the sentiment is still not as robust as we would like it. Lithium miners and producers would likely want their production to be directly hedged with manufacturers that need the supply rather than have an exchange handling it. But as it was earlier said, the CME, for example, already launched it and has been growing. Hopefully, the SGX contracts would also grow to have more transparency in that area and possibly provide more activity in providing more supply.
Yeah, I definitely agree. And I actually just have one comment is that, well, having gone through the past 2 years, recent 2 years in what happened in oil and gas and electricity, energy resources are critical. Metals, battery metals supporting critical future energy resources are important. And what is called lithium in Chinese is we call it the white oil. So what happened in oil now might happen, could happen, possibly it will happen in future on a more general perspective.
Yeah, and it's 100%. What Joyce has got it spot on. Lithium, I think they're struggling, and LME certainly is struggling. Which sector lithium goes into? Is it energy? Is it materials? Is it, where does it sit? You remember back in the early days when the combustion engine, and going back in history again, Sean, showing my age again, going back to history, if you look at the Rockefellers, the Gettys, first thing they did when that combustion engine was invented, they just went and staked every bit of land across the US that had any hint of oil. And that's what we're seeing now is a land grab for lithium. For the Argentine salars are basically all pegged. Chile's all pegged. Not so much in hard rock. There's still a few hard rock places around. I'm not saying where they are. But the land grab started. And so we're going to see, as I said earlier, 5-6% of the world has EVs. That's moving to between 50 and 60% over the next 10 years. So lithium, copper, and nickel will end up being energy-type materials.
I definitely agree. So that's why the LME and CME, they call it battery metals or new energy materials. Yeah, ESG markets, including carbon.
And if I may have a comment about the white oil, right? That Joyce mentioned, and this is pushing also the battery manufacturers and perhaps the OEM to other sources of lithium, which is from the recycling space, which is something, if you look at the investment in that space, is huge. In fact, they're predicting overcapacity of recycling plants currently being planned. And the recycling space is, I think, going to be very important if you look further down the road. And this is a space where you can mine lithium from and potentially very, very good quality lithium hydroxide as well. And if you look at the numbers for, in terms of ESG and the numbers for carbon abatement, I think recycling is quite promising. There's still a lot of work to be done, especially not only in reducing the energy to extract the metals, but then improving that this quality of metals that you extract can go back and work well in the battery as well. So those are still ongoing, but I certainly see this as an important trend as well that will affect how the sources of lithium or other minerals going to come from.
Yeah, I completely agree. In one of our analysis, we looked at whether, assuming that no new exploration will be done currently, based on currently known reserves, and we forecast the demand based on an economics-based transition scenario and a net zero scenario where we aim for zero tailpipe emissions in road transport, then there definitely won't be enough resources and reserves. And that's where recycling will be a big factor. The main challenge really is, of course, apart from development of technology, the retirement of batteries available for recycling. That won't likely come into play around the next few years. And the batteries that will likely retire earlier have very different chemistries from the ones that are already being manufactured now and will be manufactured in the future. A lot of the batteries that are currently deployed either have a different chemistry with much less materials that we need. Therefore, in terms of per battery, the amount of metals we can recycle are quite low. So we need to wait a little bit further for those retirements to actually be available for recycling. But definitely, recycling will be crucial in meeting the challenges in terms of supply, especially in the next decade after 2030.
So we have time for one or two more questions. Go ahead.
Hi. Okay. I just wanted to understand battery technology and whether there are any potential disruptors. For example, I see like nickel, for example. It's becoming expensive. It's very difficult to mine. It's very rare to get nickel, good grade nickel, and you cut off the Russians. And so, we have a big problem. Can we replace nickel? Is it possible?
We can definitely replace nickel, but it's sort of not a question of whether we can, it's whether we have the capability in doing so, given that the development of battery chemistries in this space is quite difficult. I think it was mentioned that lithium hydroxide is a very technical process, especially in terms of refining. Much more so in actual battery manufacturing. It's a highly technological manufacturing area. That's why even, for example, if Indonesia has a lot of nickel, it's not necessarily that they have the capability of supporting that nickel going into batteries because they don't have the expertise in that area yet. That's something they're
I wanted
working
to
on.
understand whether there was any existing disruptive technologies
so-
in terms of the battery
Yeah,
configurations.
as one who sits on a lot of nickel, I'm hoping this is not the case, but the LFP is right now the majority of Chinese EVs on the road are not using any nickel or cobalt. So that is a disruptor to some extent, but yeah, it's old
existing,
technology.
yeah.
It,
But
it actually doesn't matter. Prices matter. If the prices
Yeah.
are too high for the consumers, eventually everyone.
I think
will find
what
alternative
disruptors
to-
are being sort of, at least from my understanding, like, are you referring to solid state batteries or other types of batteries, essentially? Yeah.
I think you've got to go back to, when did Tesla start? How many years ago do you think Tesla started? 10 years ago? 20 years ago, 2003. They developed the first lithium-ion battery with Panasonic. That's 20 years of development to get to where we are today. I think there will be a disruptor. I don't know what it's going to be. Cobalt was a concern that they phased that out so quickly. Lithium's the second lightest material on Earth. That's one reason why lithium's so important. It holds charge better than any other material. So you need light material to run a car to make it, more efficient for the charge. Nickel, I wasn't, nickel. I think graphite will be I think the next one to come in. But to lithium-ion batteries is 20-year-old technology now. So they've got to be starting now on a new disruptive technology I'm sure it's going to happen, but I just don't think it's going to be within the next 10 years.
And the other
That's the main point as well. I was referring to, because they need to have that crucial acceptability within the market and their own approvals within the industry to actually be marketable and scalable. So yeah, I completely agree.
and they can't shift overnight. So the investment decisions they're making now at the gigafactories sort of locks lots of demand in on a certain track. So there will be innovation, obviously, but it will react, as Joyce says, to the prices, but none of that happens quickly.
Well, maybe I'll just add that for the high performance battery that you mentioned, I think at least in the next 5 years, Sean will be happy to hear. I think the nickel content will still it will be difficult, but there are high manganese content cathodes that people are trying to develop. So those can be nickel free. It will be mostly manganese aluminum, for example. And in the LFP space, then people are trying to improve the performance. In, for example, again, LMFP is also one of the chemistries that probably may come on, but it will still not hit what the nickel manganese. Solid state uses the same cathode essentially. It just changes the
But even with solid state, right? The earliest we see them being scalable and start to have market intervention would really be around the 2035s, given that it's really difficult to get something approved within this space. So in terms of disruption, yes, there will be. Prices will control which chemistries will likely take charge, especially as it develops within the short to midterm. If you track the deployments of which batteries are being manufactured in China, LFP really grew like towards the end of 2021, and it's such a massive jump. That could also change, like if prices are affected in any way, then that could also change further. But also one thing that would really be interesting is that we don't see these fights or arguments around chemistry as disruptors. Rather, it gives more choices for the market. It's actually leading to more prospects for aiding in electric vehicle adoption and battery growth rather than derailing the EV revolution per se. So if you have more chemistries, then you have more spread in terms of which materials you're going to need, and therefore more options for manufacturers to actually put out more models of EVs based on those chemistries. And what we've seen really is that if there are more models of EVs, then it really drives adoption way higher. That's what we've seen in China, that's what we're seeing in the US, and that's what we're seeing in Europe, the major car markets.
Some people talk about hydrogen, and so I did a bit of research on hydrogen. So Tesla built 3,000 supercharged stations from Los Angeles to New York a few years ago. Each one of those stations cost $100,000. So you can drive from LA to New York with charging stations. To build a hydrogen charging station, it's 4 stories high. It's about $3.5 million to build. So and that stuck out to me, saying, okay, so how can the three have? You might need 3,000. Call it half that. 1,500 hydrogen stations. You're going to have environmental issues. You have people complaining, like we have with cell towers. So hydrogen, I think, will be used for trains, ships, major trucks. I don't think you'll see it anytime soon in that EV sort of scenario.
Yeah, I completely agree in terms of hydrogen. Sorry, just to cut it a bit. So in terms of road transport, definitely hydrogen, just plainly because of economics, can compete with what battery electric vehicles can offer. Although if you segment the road transport further, then they have more options for hard to abate segments such as commercial vehicles and trucks. But that still remains to be seen. But yeah, I completely agree. Road transport would still be battery electric in the meantime.
Again, a final comment. I'm sorry, guys, but this is to a wider audience group that it's like risk management, technologies, research, automakers. They don't put their eggs in the same basket. You got to develop technology. You got to always think about how you're going to manage your price risks, how you're going to manage the all of the events, black swans, great rhinos, elephants in the room. They could happen, right? So people really have to, I mean, the diversity of technologies are definitely there. And I believe in Xinyan's hard work, and there will be better developments. So I guess that.
That is a great place for us to wrap up. As I was telling the panel earlier, it's really hard to keep these under an hour, but I want to thank Joyce, Chris, Alan, Singing, and Sean for joining us here today. And most of them should be around, if you want
Thanks,
to talk
Amy.
more batteries. And it's actually a very good lead in to our next presentation, which is going to be all about hydrogen. So thanks to the panel.